Fake it till you make it, Jerome. Fake it until you make it. Our banking system has never been stronger. Our banking system has never been stronger. Our banking system.
Sir, another bank just collapsed.
For Christ's sake, what is it now?
It's almost like it's not a good idea to gamble alone at 95% of your customers' deposits because when they lose confidence in your bank, you don't have the funds to cover the withdrawals.
Jenkins, you're fired. But before you go, call Jamie Dimon. Ask him if he'll buy it for $40.
$40, sir? Are you sure? It's a multi-billion-dollar bank.
You're right. Probably too high. Tell him $15 and not a penny less.
The press conference is ready for you, sir.
Our banking system has never been stronger. Can we get hair and makeup in here, Jenkins? I look like an elderly emo Karen. Hey everyone, welcome to Campbell's Coins. Today I have Lior Gantz with me. He is the co-founder of Wealth Research Group, global investor, and entrepreneur. You've probably seen him on a lot of channels out there. Well, he is a wealth of knowledge, and with everything going on in the markets, I thought he would be the perfect guest to have on. Hey Lior, thank you for joining us and taking the time to speak to me and my viewers.
Yeah, thanks for having me.
Let's dive into the questions. So this week, gold and silver, it was hammered down. There was a slight rally on Friday. Do you think that this is odd considering that the U.S. is heading towards a debt default with basically no backup plan? And how worried should we be if the debt ceiling isn't lifted?
Of course. So first of all, let's address the price drop this week. After toying with an all-time high for the past 2-3 weeks here, on the backs of the regional banking crisis, the debt ceiling, and the market assumption that May was the last rate hike, gold rallied, and it rallied good. But in the past week, both Thomas Barkin and Bostic, two Fed governors from two different regions, have said that this is not the time to pause. This is not the time to stop raising rates. And that was the first catalyst for driving the expectations of the market back towards another rate hike. And that immediately cost gold at least $50. So it went from around 2040 to around 1990. And then on top of that, more and more news outlets have tried to calm the nerves of the market regarding the debt ceiling and the X date, which is currently I think June 5th or June 6th when the Treasury runs out of cash. So between both of these and the fact that the three unconventional programs that the Fed is doing to help alleviate the stress on the regional banking crisis, these are the discount window and the term lending, the term funding program. Between these three, they're really helping the banks. And as you know, there's 4,000 banks in the United States. So even though the three that have failed or merged are quite big, the banking system as a whole is doing okay. Now, with regards to the debt ceiling, defaulting on debt is on such an extreme end of the axis that I don't think that is really what the market is truly concerned about. But way more than in previous times, and we've raised, the Americans have, the Congress has raised the debt ceiling under virtually all presidents in the past 30 years, and numerous occasions. So raising the debt ceiling is not something that's difficult for the Congress to do. What's difficult for the Congress to do is default. That is essentially the biggest game changer in modern finance if that happens. Every generation of Americans know that a man is a man because he pays his debts. So obligations must be met, and that culture has morphed into such a degree that America's debt or the treasuries um, is the risk-free rate for the rest of the world. That's how the entire asset universe is based. So for them to default, it would require much more than just some bipartisan leverage from the Republican side or from the Democrat side, whoever is president. I don't think we're going into any default. I think that they'll raise the debt ceiling, but I do think that contrary to previous times, I think that there will be far more debate on, okay, we've raised the debt ceiling, but how do we start to remedy the unsustainable deficit spending that this country has embarked on since the early 80s? So I think that what's different this time is that during this presidential cycle, I think that a lot of talk will be about fiscal responsibility and getting the balance sheet of the United States back to a degree that's more sustainable, where the expenses and the income from taxes and such start to look better. Because of high inflation, everybody in the United States now knows about the national debt. So it's not something that's opaque or vague or in the back of people's minds, like it was when inflation was under 2% you know uh, for more than a decade. Now it's top of mind, and people understand that there's an issue. They obviously most people don't know it's a $30 trillion issue and growing, but I think that it's definitely something that's much more discussed at dinner tables and in college and academia. People know from boomers to teenagers. People know that there's a problem with the debt. So I do think that that's important. Then on Friday, as you alluded to, gold rebounded. The reason it rebounded is because um, some some important Fed governor has died, and because an excellent employee, I mean, and Bernanke and Powell did a Q&A session as a tribute to his memory, and they commemorated his memory, but they also used it as an opportunity to explain the Fed's actions. And Powell talked a lot about the fact that because of these programs that I mentioned earlier, um, they won't need to do as much rate hikes as as in the 1970s. And they also talked about a lot of other differences between the 1970s and today's situation, which, if you want me to address, I can address later in the interview. But suffice to say, that helped to take gold up by about $20 back to closing the week at 1987. So an ounce. So I think that overall, what we have here in terms of the debt ceiling crisis is something that people are taking seriously. They're preparing for it. In fact, J.P. Morgan has created a war room. If you know what CDS is, which is collateralized debt swaps, it's basically if you hold debt of a denomination like the dollar, you swap it for euro debt. So if you swap it, you pay the other party a premium because you're asking for the swap. You're asking, hey, hold my debt. I will take your debt. For that swap, I will pay you. So that swap, the dollar euro debt swap, is an all-time high, like it wasn't in any other time in U.S. history. Not in 2001, not in 2008, not during Brexit, not during the pandemic. I mean, people are taking this very seriously. So I don't think that the Congress will play with it. Jerome Powell has warned that if they even try to do anything funny, that will be in uncharted territory. He said, basically, we don't have a playbook for this. Warren Buffett has talked about it in Berkshire's annual meeting a couple of weeks ago. It's the last thing on the excess of options. And just so you understand, default, it could be default to creditors. That will be like the extreme worst scenario. But apart from that, the government can stop paying, for example, Social Security, or delay salary to workers. That wouldn't be unprecedented. But to not pay interest, that would be suicidal.
I would agree. As far as I know, they've never not raised the debt ceiling, and it's almost become a political ploy for those in power to, use things to their advantage to get certain things through. I do want to discuss with you the reason why gold went up on Friday. You mentioned Jerome Powell, but also Janet Yellen met with JP Morgan CEO Jamie Dimon and Jan Fraser of Citigroup, saying that the banking crisis isn't over. Further bank consolidations may be needed by the larger banks. Will we see more regional banks topple? And how bad do you think this will shake the economy?
Um, if you look on aggregate at what we call mark-to-market bonds, in other words, bonds that have been purchased by regional banks as part of their portfolio. So any bank works on the same business model. All banks work on the same business model. They try to borrow at the short-term rates, which are supposed to be lower than long-term rates, and then lend out at long-term rates. Called that's called a healthy yield curve. When you have a straightforward yield curve, if you borrow from the government or from other banks or from anything that's short term, you would pay a lower interest rate because the risk you're taking on a 3-month loan or a 6-month loan is deemed way lower than lending out to an institution or an individual for 10 to 20, 30 years. You ask for more risk premium on that. And that's the business model. Now, what happens is if depositors put $100 billion into a bank, then the bank uses that deposit as collateral to make investments. And the easiest way to make an investment is to buy some treasuries, because that's the risk-free investment. Nobody will fire you for buying treasury bonds, and all is well with the world. And what happens is, if you have a certain type of a depositor, let's say concentrated in high tech, which is what Silicon Valley Bank did, but we can talk about other banks and their problems. If you have depositors that are in concentrated in a very capital sensitive capital intensive industry like tech, which burns money and loses on the bottom line, at least for startups. And on the flip side, you have a bank manager or a portfolio manager for the bank that has bought securities that are long dated and they're bonds. And the more interest rates rise, the value of the bond collapses. And I can explain very shortly why. Imagine that the government has a 10-year bond that they now have at 1%. This is just 2 years ago. 1% for 10 years. If you invest $1 million, 1% of that is $10,000. That's going to be your interest payment. Now, if the government or if the Fed raises the Fed funds rate from 0 to 1 to 1 to 2, now interest rates on the 10-year bond is at 2.5%. Let's say 2% just to make it easier. It just rose from 1% to 2%. In order for me as an investor to make that same $10,000 income, I can now buy, or I can now lend the government only $500,000 and still make that $1,000. So now the guy that lent the government $1 million to get that $10,000 can now sell his bond in the market for half of what he has it for. The face value has collapsed by 50% because of a 1% rise in interest rates. And that's what a Silicon Valley Bank is dealt with. And at the same time, they had to sell at a big loss. If you just held to maturity, you would get your $1 million back. You won't have to sell it at a distressed price. But because depositors asked for their money, they had to sell at a loss, and that created insolvency. So, do other banks have that problem? They sure do, and they have it to a very high degree. That's why the Fed has created short-term solutions for these banks to weather through this period. Now, if you have a higher for longer period of interest rates at 5%, then you get to a situation where if depositors do need their money back, or if they want to just move it into money market accounts where they can now get 5, 6, 7%, then you're in a problem. And I think that what we will see from here until, let's say, about September, October, um, is three things. You will see one, the lag effect, LAG, the lag effect of interest rates, because the Fed believes that they've tightened enough to where um, the actual tsunami of credit tightening and all the effect of what they've done is still ahead of us. So they believe that between now and September, you will start seeing um, this credit tightening play out in the real economy. They think that we will see a bit more layoffs, more right sizing with corporations. They believe that the consumer will start getting less splurging and more saving. And they think that in general, hiring and the amount of people that are out there looking for a job will even out or start to look better, because right now there are 2 job openings for every 1 employee that actually wants a job, and that's a very unprecedented situation in the United States when you have already such a low unemployment rate, actually record low. So the lag effect is what we'll see. The lag effect will actually dictate if we have a hard landing, a soft landing, no landing, or recession. So that's in the cards for the next 3, 4 months here. And then the third thing that you've just talked about is this banking crisis going to be averted, or will we actually see more regional banks toppling over? The one thing that most people actually don't know, because it's not that publicized and broadcasted, is that it is the regional banks that actually lend out most of the commercial real estate mortgages, not the big banks, not the JP Morgans and the Wells. It's actually the problematic, the office sector is actually originating in the regional banking. So that's really an interesting part of this, because those are the loans that have to now be refinanced at very high levels compared to before, with lower occupancy in those buildings. So if we will see a commercial real estate reset, price declines of 15, 20%, then it's coming now, coming in the next 3, 4 months. So I believe that the next 3, 4 months will be very difficult for markets. They will be very difficult for any asset class, apart from cash, that will offer optionality for those seeking opportunities. And then towards September is when I think the Fed will have to start addressing what's happening. It will have to start saying, hey, it looks like a hard landing, it looks like a soft landing, it looks like we've avoided any landing, or it looks like a recession. And because of that level of uncertainty, I think that between now and September is not the time to decide big portfolio moves.
You actually answered my next question about the time frame. That is part 1 of my interview with Lior. Make sure you tune in next week for part 2. If you enjoyed this conversation, you're going to love it next week. We dive into metals, geopolitics, and so much more. I have Lior's information listed down in the description of this video if you want to look into some of his insights. Your time is your most precious asset, and I appreciate you spending it here with me. Thank you all for watching. This is Campbell's Coins, and that is my 2 cents.